What if we were to run the numbers on Luff? Today, we're going to conduct a 5-year financial audit that compares a serious romantic relationship to a simple stock market investment. We're calling it Heart versus Hedge Fund.
And this whole exercise really boils down to one fundamental question. From a purely financial perspective, is love a good investment?
So here's how we'll do this. We're going to track 2 parallel paths for our subject. We'll call him Alex, from early 2021 to early 2026. In one scenario, Alex invests his time and money into a relationship. In the other, an alternate Alex invests every single one of those dollars into an S&P 500 index fund instead.
But before we can start auditing Alex's spending, we have to understand the unique economic battlefield of the last 5 years. It was an environment that penalized both savers and spenders, something we're calling the double penalty economy.
Think about the timeline. The period kicked off with a massive post-lockdown spending surge in 2021. That led directly to peak inflation in 2022, which made everything much more expensive. But right as that was happening, the AI boom ignited in 2023, sending the stock market to all-time highs by 2026. And there's the penalty. The cost of things like date nights skyrocketed, while the opportunity cost of not being invested in the market became absolutely massive.
Now, to accurately measure the rising cost of romance, we actually created a specialized metric for this analysis, the Dating Consumer Price Index, or DCPI. This tracks inflation specifically for things like restaurant dinners, travel, and entertainment, all of which, it turns out, saw prices rise even faster than the standard inflation rate.
Let's just take a simple dinner date to make this concrete. Back in 2021, a nice night out for 2 might have cost you around $90. Well, fast forward to 2026, and thanks to that DCPI, the exact same dinner experience is now closer to $150.
But here's where the other side of that double penalty really hits home. While the cost of that dinner was climbing, the stock market was doing something truly historic. For example, an investment in a company like NVIDIA exploded by well over 1,000%. This perfectly illustrates the opportunity cost. Choosing those candlelight dinners meant you were missing out on a once-in-a-generation market run.
All right, let's start by looking at Path A, auditing the heart. We're going to break down all of Alex's relationship spending year by year.
We found that the financial life cycle of the relationship really broke down into 3 distinct phases. It starts with courtship, which is characterized by a high volume of frequent, lower-cost dates. Then it moves into the comfort phase, fewer dates but bigger, higher-quality experiences like vacations. And finally, it ends in commitment, which involves high-stakes expenses, like an engagement ring.
In business terms, you could think of year 1 as the customer acquisition cost. For Alex, the total price of securing a partner through all those initial dates and activities came to $7,200.
For years 2 and 3 combined, the total spending rose to $15,000. And it's crucial to remember, this spending happened right during the peak of that inflationary wave, meaning every one of those dollars would have been that much more valuable if it had been invested instead.
The final 2 years, the commitment phase, saw the highest spending by far, $21,900. Now that number is driven largely by one single major purchase, a $7,500 engagement ring.
So now we pivot to Path B, the counterfactual portfolio. This is the alternate reality. What would have happened if every dollar spent on dating was instead put into the market?
The investment strategy here was kept very simple. Every dollar Alex would have spent on the relationship instead went directly into an S&P 500 index fund. This means the portfolio was naturally dominated by the tech giants that were driving that AI bull market, companies like NVIDIA, Microsoft, and Meta.
This simulation shows us exactly how that portfolio grew, year by year. Pay close attention to that crucial period in 2022. Just as Alex was spending money during peak inflation, the portfolio was aggressively buying up shares while the market was in a slump. That single action is what supercharged the subsequent returns, growing the initial invested capital to a final value of approximately $72,000. And there it is, $72,000. That is the total opportunity cost of this 5-year relationship. That number is made up of 2 parts, the $44,100 he actually spent, plus the nearly $28,000 in market gains that he never realized.
So this brings us to the reckoning. On paper, the numbers seem to tell a very clear story, but this is where we need to challenge the very definition of return on investment.
So this is the real question we have to ask ourselves.
On Valentine's Day 2026, looking at these two very different outcomes, which version of Alex is truly the winner?
You see, the relationship portfolio, while it didn't pay cash dividends, it generated its own set of incredibly powerful returns. We identified 4 key ones: what we call dual income alpha, a health dividend, a memory dividend, and finally, significant risk mitigation.
And we can actually put a hard number on one of those. By moving in together for the last 2 years, Alex and his partner saved a significant amount of money on rent. Alex's personal share of those savings alone came to $24,000. This dual income alpha claws back a huge portion of those missed market gains, right off the top.
So all of this brings us to the final verdict. And what this analysis suggests is a truly smart money strategy for life.
Here's our conclusion. While the S&P 500 clearly wins the short game based on pure mathematics, a strong partnership provides what we'd call a far superior total life return. Because really, any financial analysis that doesn't account for well-being is simply incomplete.
After all, when the market inevitably crashes, and it always does, you can't exactly hug your stock portfolio.
And so, this analysis leaves us with one final question. It's not about Alex, but about you. How are you measuring your own total life return?